Hi, everyone. It's Grant Evans speaking. I'm here with Michael Jeffries. How are you, Michael?
I'm great, thanks, Grant. How are you?
Yeah, good, thank you. This is oh gosh, trust distribution minutes. I think I've done thousands of these over the time. So, I mean, my background, where I came from, the Tax Institute, went to KPMG, and forever doing. A lot of my clients were the big banks like Barclays and a lot of the wealth managers. And forever we were doing unit trust distribution minutes, which would obviously include tax-free and tax-preferred distributions coming through. And they had an impact, particularly on the unit price, that a tax-free distribution would obviously be go to reduce the underlying pricing of the unit for capital gains tax purposes. Now, of
Correct.
course, then suddenly we had a couple of questions, and I know, Michael, you're well on top of all the cash flow bonus, and I'll let you maybe do the first slide anyway and just talk about it. But we've had a couple of questions on how do we treat the cash flow bonus for trust distribution minutes. And we'll go through it. A lot of it's obviously going to be very, very important. In fact, not very, highly important on your deed. And a couple of ones we've reviewed in the last couple of weeks don't even allow streaming. So you're in a pretty bad position there. So we've sort of set in place a system there that Mike will take you through a bit later on, that you can specifically nominate that payment of which is non-taxable, non-assessable, non-exempt income referable to cash flow bonus. You can specifically allocate that to obviously any beneficiary. Now, you're not going to want to throw it into a company, because if it's tax-free, it's tax-free. It doesn't make sense to put it into a company. But one of the ones there is that just going back is that we had a few queries. So we thought, well, rather than answer the queries, it's best to do a webinar and cover it up and basically show you exactly what to do, which is the way we do it at Lightyear Docs. And also I love SMSF to make sure that we're doing things better. And for those people who can't turn up, then it's going to be recorded. You can have a look. It's far better to go and look and see and hear from the experts rather than try to plump around as well. Because I know you had a bit of a discussion with the tax office, didn't you, I think, Michael, around this issue?
I did, correct, Grant. So,
and what do they come back with? We're still thinking about it.
Yeah, well, they've been interesting in deal with of late, obviously during COVID, because they seem to be quite under-resourced in relation to dealing with JobKeeper, the cash flow bonus, and I guess a lot of inquiries around all of that. So they seem to be taking a lot longer than what they normally would to respond. But
yeah, I know. Even I saw they got fairly aggressive around that. The $10,000 superannuation withdrawal.
Yeah, there's a lot of stuff come out over the weekend on that. So
yeah, it was quite funny actually, because they were saying, look, unless there's been a significant reduction in your income and your hours, that we're going to have a ping at you. But legislation actually says it's just simply a reduction in your hours. That was all there. And the fact that you spend it on gambling, I mean, that's just a load of industry fund bullshit anyway. But the fact that whatever you spend it on is immaterial. It's accessible, and the whole intent is to keep people going through.
Yeah, it's quite difficult for them to, in terms around the hour. I mean, I could drop to 4 days per week and still receive the same.
Exactly. In fact, most people did. I know my ex-wife, she's working at Price Waterhouse, and they went to 4-day weeks. And as soon as they do that, it didn't drop her income. But as soon as they did that, effectively they're in line for taking that amount. But again, of course, it's a scare factor, because I'm expecting 1 million people to withdraw. Now it's like 2.1 million. And of course, there's the lead up to 30 June, so word will spread on social media. And then, of course, everyone's going to be going again on the 1st of July, which will be interesting. Anyway, do you want to, obviously, I've got up there, this is straight from the Treasury fact sheet. The government is providing temporary cash flow support to small and medium businesses and not-for-profits, employ staff during the economic downturn associated with COVID. This will be done through 2 sets of cash flow boosts delivered from the 28th of April 2020 to support employers to retain employees. the government will provide tax-free, and that's the important, tax-free cash flow boosts between 20,000 and 100,000 to eligible businesses, delivered through credits in the activity statement system when eligible businesses lodge their activity statements. Eligible businesses do not need to apply with a separate form. Upon lodgement of the activity statement, the first amount will automatically be credited to the business account, but no earlier than 28th of April 2020. Business lodges early will not receive cash flow boost before this date. And of course, it's also September. Do you just want to give us a bit of a heads up particularly for the planners and the lawyers, and pretend you're just talking to Tony Anamoulis as to what the payment system or the cash flow system has worked like in practice for your clients?
Yeah, so effectively in operation, the accountant, or I guess clients who lodge their own BASs, when they lodge, they're starting from Q3 2020, would lodge their BAS, and assuming they met the criteria and the fact that they had paid wages previously, had lodged a BAS in the previous financial year in which there was income, and there are some rules around startups and stuff that change that, but that they would receive a cash flow bonus as a minimum of 10,000, but effectively equivalent to their PAYG withholding for that quarter. So my PAYG withholding was $25,000 for my staff. I'd get a cash flow bonus of $25,000. So
it's effectively would I be correct? I mean, it's hard to characterise, but the reason I wanted to go through this particularly with Michael, who's very experienced in this, is from a legal point of view, we need to give it a characterisation of what it is, because it's also going to apply from July, is that right?
It would be through to the September quarter, so the Q1 21.
Okay, cool. So that's the same thing. So when they say it's 100,000, is that 100,000 in total across both years, or is it 100,000?
Yeah, 100,000 across.
Both. Okay, so when we receive that and we're doing our end of year accounts, and I want to show you, I'm going to I'll show you a little bit later on the Treasury stat, or actually I've got it on one of the slides coming up. But how would you treat that from an accounting perspective? Because it's, as I said, it's an expense. The PAYG is actually being paid, because you don't get the cash flow bonus unless you pay. Is that correct?
Correct. So when you process your payroll, your wages, there'd be a calculation of as per normal PAYG, which would go to your balance sheet. And in that case, the $25,000. So it'd be sitting there as a liability, and then you lodge your BAS and you get in effect a credit. Some people have received cash back, but in effect a credit of that PAYG withholding. So you obviously can't leave that liability sitting on your balance sheet. Mm-hmm. So the way I've been treating it is taking a journal up and putting it into other revenue, which in effect is exempt other revenue. And just leaving obviously your wages grossed up within your expense.
Yeah. So we'll forget about accounting. I'm just wondering whether it's under the P&L, whether it'd be a negative expense, that's a reimbursement of an expense that's already been incurred.
Yeah.
Or is it just going straight to the top line as a profit item?
Yeah, I
suppose it doesn't matter in the long run.
I put either as other income or which can be below, like an abnormal income item. So you have other income and expenses where you often have interest and interest income and interest expense, or you can have it in your revenue line as other income. It probably makes sense more as that other income and expense, because it's of abnormal type nature. It's not going to recur. Yeah. Although you receive it again in 21, but not in the following years.
So when we have a look at the trust anyway, so I'm just on the next slide here. One of the big ones, of course, is what does your trust deed actually say in relation to trust distribution? So obviously a lot will have net income. If you're stuck with net income, then you're basically stuffed. Because this will be an accounting income. You'll see a bit later, and Mike will explain that's not taxable income. So if you're looking at net income, you're virtually out the door anyway. So you need to have that flexibility in your deed that, in essence, the trustee of the trust should be able to characterise anything, for that matter, Doesn't have to say it's accounting or net income, but should be able to characterise anything as income and characterise anything as able to be distributed. Would you agree with that one?
I would, correct, yeah.
Yeah, cool. So how is income determined? You need to have a look at the deed itself, which is crucial. I think there's just a question there, if you could answer that quickly, Michael. Who are the beneficiaries and how can income be allocated? And more importantly, is there a default beneficiary just in case there is an adjustment later on? And that should be an adjustment to accounting income or taxable income.
And
one of the things I just want to bounce out.
Yeah, the important point there is it's trust income. There's no reference ever to effectively taxable income, even though a trustee may state net income. It's always it's the income of the trust, whether that means accounting income or net income. We've referenced to section 95.
Yeah, so I've got our trust deed up here. So I'll just go in and, sorry, you can see this is actually the this is the one that's pre-coded, but we've got here, income of the trust means that amount is determined by the trustee, including accounting income. And if the trustee makes no such determination, income means all profit or gains less expenses taken into account and calculate the net income of the trust and exempt income as defined in section 95(1) of the Act, notwithstanding that the whole or any part thereof may constitute capital. So again, that's virtually saying, well, it's only up to the trustee to determine what is income from that perspective. So we're okay with that one. Now, one of the ones is, I won't have time to go in, but essentially, if we have a look, I just want to look at this one case for you. So a lot of existing deeds just aren't up to scratch, and really they need to be upgraded. The big one for us, though, has been this big resettlement issue, and it's quite interesting that this, you can see here's a tax determination, and this is really key for all of you accountants out there, and for that matter lawyers who are looking at existing deeds and being concerned about resettlement. Now, I've got income tax, does CGT event E1 or E2 in respect of 105, 104.55, 104.60 of the ITAA 97, having the terms of the trust are changed pursuant to a valid exercise of a power contained within the trust constituent document or vary with the approval of relevant court. So, for example, we're going to get rid of one deed or one set of rules. You never change a deed, but then you put in a new set of rules. And the Commissioner says here is no. And I just wanted to take you importantly down to this area here, and I just want to spend a couple of minutes on this. So this is the appendix, and this is where all the guts and the law comes in. So one question has arisen concerning the scope of this event is whether an existing trust can change in such a fundamental way that although the trust has not terminated for trust law purposes, and that's crucial because the deed, unless you vest and wind up the trust, is always going to be there. And you might change all the terms and conditions, but it's still the same existing trust. Nonetheless, for tax purposes, a new trust has come into being, hence the resettlement. Now, this is the key here. In June 1999, in response to the full federal court's decision in Federal Commission Taxation versus Commercial Nominees, the Commissioner published a statement of principles to guide taxpayers, advisors and the ATO decision makers on when the Commissioner would treat changes to a trust as giving rise to a new trust estate for income tax purposes, resettlement. The basic proposition underlying that statement was that a new trust arises for these purposes where there is a fundamental change to the trust relationship. The change in the essential nature and character of the trust relationship can result in the creation of the new trust. So that's why everyone just freaked out, because if we change the beneficiaries, is that a fundamental change? If we change the trustee, probably not a fundamental change. If we had a pre-Banford and then what we did is we actually inserted in there some streaming of income, is that a fundamental change? Now, this is important because the Commissioner has come back and look, this is gutsy. Look, let's go on. On the 21st of January 2011, the full Federal Court handed down its judgment in the Commission of Taxation versus Clark. So that's later than Commercial Nominees. That case raised squarely for consideration the circumstances in which the nature of trust has so changed that it might be concluded the trust that originally incurred capital losses is not the same trust for income tax purposes as that which was derived gains against which the losses are sought. So you can see what the Commissioner was doing was obviously trying to say, look, it's fundamental that effectively those losses are stuck in a different trust. Now, Clark was decided adversely to the Commissioner. Special leave sought by the Commissioner appeal the decision to the High Court was rejected on September 2011. So if we go down, furthermore, as a general proposition, it would seem that the approach adopted by the full Federal Court and commercial nominees, as explained by Evans and Gordon J and Clark, is authority for the proposition, assuming there is some continuity of property membership of the trust, an amendment to the trust that is made in proper exercise of power to amendment contained under the deed will not have the result of terminating the trust, irrespective of the extent of the amendments so made, so long as the amendments are properly supported by the power. Now, 23. However, in light of the full Federal Court's decision, Clark and the High Court's disposal of the Commissioner's special leave application, is apparent that continuity of trust is a function of whether the trust continues in existence under trust law in contradistinction to having terminated. And so understood, the comments made by Federal Court in commercial nominees relating to amendments to trust obligations represent good law. So what we're doing there is we're effectively, the Commissioner's saying, look, you can virtually, and you can go through all these examples here, he's got heaps, but you can change the vesting date as long as you don't go beyond the rule of perpetuities. You can change your investment powers, you can change your beneficiaries, you can change everything, even classes of beneficiaries. It is only, for example, where a lot of people have been doing trust splitting, that potentially there is a new trust there. But from that perspective, you can effectively go and upgrade your deed to one of the light year docs deeds. Then you're actually going to have a good foundation base in which to make those distributions. So let's just move on again. So it's not too late to vary. I'd be looking from an accounting perspective is to make sure that all my clients effectively have a modern updated deed, given the fact that there's not a resettlement. We can rely on TD 2012/21. Resident minors, I won't go that, but you'll see if it's obviously tax-free and not exempt income, that a distribution to minors is obviously not going to be accessible. Now, I won't go, if you were upgrading, don't upgrade straight to a discretionary trust, a light year docs discretionary trust. We have got in play there a family protection trust, which enables obviously tax income splitting, bankruptcy protection, litigation protection, family law. It's just a lot stronger because essentially the key there is it really has a good bloodline limitation. Okay, so how is the cash flow bonus treated? So the initial cash flow boost will be delivered as credits in the activity statement, as Michael said. Eligible entities who receive initial cash flow boost will receive additional cash flow boost for the period June to September. Now, this is straight from the Treasury paper. Oh, sorry, this is straight from the Treasury paper. All cash flow boosts are tax-free, non-assessable, non-exempt income, and are not required to be paid back when the business cash flow improves. Is it the same as a grant or repayment expenses or a simple gift? Oh, it's almost akin to almost like a gift. So what I'll do there is I'll just bounce out of there. Do you want to share your screen, Michael? And then we can, if you want to go through the distribution. So I'll just stop sharing now if you want to share your screen.
Yep.
Okay.
So I'll jump into...
Perfect. Look, it works, Michael. Share screen. Hallelujah.
It's amazing. So I just jumped into the trust section, which contains our distribution minutes. So discretionary trust distribution minutes. You can see if you're a light year basic user, they'd cost you $49 for each set of minutes. So obviously, if you're under one of our member programs, you receive those for free, and so you can run as many as you want. Start the document. I'll put it under MJ test. Start. I always use what my naming convention is here for my clients. So for myself, I'd use Jeff M, and we might call it FY20 trust minutes or something.
Have you been doing these for your clients at all, or?
I have been. Just especially this is one of the busiest periods of time for accountants, advisors. Obviously, this week is we're coming up to 30 June. What are we? 8 days off.
I know. It's actually quite interesting because if people do minutes and the minutes don't properly reflect, or for example, they can't be distributed, then effectively what will happen is they'll be retained in the trust. So Section 97 won't apply to tax the trust. It'll just be retained in there, and obviously will be tax-free. So if you put it on the balance sheet, then obviously becomes a capital amount.
So we'll call this the Smith Family Trust, just going with the example. Date established, we'll just say it was 1st of June. I can actually just select these sections. Trustee, we'll put a trustee, we'll call it, use one of my trustees. Legal elements, 1, 2, 3. One director, Smith Family Trust. So I'm just adding the trustee details, as you can see there. Trustee meeting, so this is the date the meeting is held. It has to be, as we've got a note there, it's on or before 30 June. And there's also a note there in relation to which I hear questions a lot. What if it falls on a weekend? There's no reason why the meeting can't be held on the weekend, as long as the trustee is available to actually hold the meetings. So if you don't know it, you can leave it blank and add it later, but I'll put it in as, we'll put it as Monday the 29th of June. Probably if you're holding a number of meetings at your office, because I often see accountants use their registered office address, because that'll be the registered office of the trustee. I'm always cautious in relation to this time, because I know when I started in public practice, everyone used to put 10 a.m. And so I'm always concerned that you could come unstuck, that you're going to have a range of 500 sets of trustee minutes that were all held at your registered office address at 10 a.m. on the 29th of June. So probably should consider the actual time of the meeting. So Roger Smith's going to attend the chair and be the chairperson as the sole director. We can select the address and fill it in from here, which is a good option and makes things a lot more efficient and fast. Now, so these trust distribution minutes then go through and refer back to the actual deed, which is important. So as we mentioned at the start, and Grant mentioned and I mentioned, that it's always the income of the trust and how it's distributed always comes back to the deed. That's the most crucial point in relation to trust, I guess, trust law and trust distribution minutes.
I think I did ours yesterday. It's 4.1.
Okay. I'll put 4.1.
Yeah. So that's the determination of the income for the trust.
It is, and this is different classes of and types of income and capital. So it may some deeds mention dividends, rent, business revenue. I know ours is quite wide in relation to the definition.
I think ours is 6.1, that one.
6.1, yeah. I know when I went through and did recently the webinar on the trust distribution minutes, I actually had our deed up and I actually made sure I referred back to it, so you can have a look at that video as well. For example of this, do you know what that one is?
Yeah, I think that was, I'm sure that was 5.7.
5.7, that rings a bell. So this is just talking about the actual calculation, how it's calculated, whether it's accounting income or effectively net income under Section 95.
So that one was, yeah.
For 5.7, yeah. So then in this case, I'll select net accounting income. Go through, and so this is the clause.
And this was 4.1, yeah.
That talks about distribution of income and how it's distributed to the actual beneficiaries.
Now, a couple of people have said, look, we've got an old deed. As I said, you're better off upgrading the deed anyway, so you know what you got. A couple of people said, well, what if I don't know? I said, look, is there a problem there? I said, look, I've said 4.1, but if you just put down 4 or 6 or 5, rather than going down the specifics, you'd still be okay from a perspective.
Yes.
Yeah.
Yeah, I mean, and talking about upgrading, I mean, we've always been big believers, both Grant and myself, and I always use it in my clients as much as I can, and is actually having an engagement as part of the engagement piece in terms of upgrading on a regular basis, especially SMSF deeds. But there's no reason why you couldn't have something around trust deeds, especially if you're on one of our membership packages and you're getting those deeds for free. And so as a way of example on SMSF, so like I have, as part of my ongoing administration accounting, I charge them a fee of $5.50 each, and which goes into it, and that includes a review every year and an upgrade of their deed. Because there's obviously changes in legislation, there's changes, we make the operative changes and improve the deeds and stuff. So,
and also, if you are going to upgrade, look, don't just sort of stick to upgrading from whatever it is, Law Central discretionary trust to like your Docs discretionary trust. Go and try the Family Protection Trust, because that way, what you're doing is you're actually overlaying over the top of your existing trust. So the trust still stays there, but what you're doing is you're giving it family protection. So you've got the first family protector at point 2, or the second, the third, and they run full control of that whole element. So that's absolutely crucial. If you're going to upgrade, well, not only have you got a whole lot of other issues around this from a technical perspective, but you're giving them an impetus to actually set them up for something that's going to secure their bloodline for their lineage for the life of that actual trust.
100%. So this is just obviously the financial year that it relates to the distribution. So we're dealing with the 2020. So I'll put that in. Can't believe it's 2020, but time's flying. So this is where we get into the actual distribution and the method in which we're distributing to our beneficiaries and the types of beneficiaries we're distributing to. So we've got individuals, companies, trusts, and charitable entities. So because we're talking about the cash flow bonus, I'm going to select stream, and I'm going to distribute a portion to and one individual, and then I'm going to also distribute some to a company, I feel. And so what I'm going to do is I'm going to put Roger Smith in here, and I'm going to distribute to him the non-assessable. I'm going to distribute it to him because we received $10,000 cash flow bonus. I'm going to distribute to him $10,000 in non-assessable exempt. Got accessible wrong there, you can see. Accessible.
And I put cash flow bonus, such as the cash flow bonus, because that way, if you put in specifics there, it is so much better. And you'll see through all of our documentation, whether you're doing an SMSF will or will testamentary trust, the power is actually not to leave it open-ended, to be specific. It's the same way with any legislation. That's where I've learned it from, is that the specifics always overrides the generality, so that if you've got an intention, you put it in there that this is really for the cash flow bonus. And again, if you don't know that if you don't know it's $10,000, then just put in any amount of blah, including cash flow bonus. You can see Mick's actually put in all non-assessable exempt accounting income effectively there.
And then to the company, I might give 50,000. I forgot the company name. Smith Assets, Smith Holdings, and legal elements. I'll put 50,000 of rent distributions. And I'll actually I'll put a trust here as well, and I'll put Smith Investment Trust. And I'll put the balance accessible income. Sort of again. What am I doing?
That's 2 S's in accessible.
Yeah, it's coming up with spelling error. And so then I've put 3 different beneficiaries there. I've put, as we've mentioned, the first individual beneficiary is receiving the non-assessable exempt income. The second is receiving, we've got some frank distributions, and then the Smith Investment Trust is receiving the balance of assessable income. We go on to the next one or more questions. What's going on?
I think you've got to go down.
No. Oh, 0.
Yeah. Which is important in that system. Whenever you see that, it means you've just got to go back and check what you've got.
Yeah, any questions where they're required questions, we've got locked into, so that happens. So
the
this
default beneficiary?
Yep, so default beneficiary. So if the ATO varies the income when they review the return for any particular reason, or there is another variation for another reason, this is where you put the default beneficiary. So we might put Roger Smith back in there. And the
of course, you can put the company in there as well if you wanted to.
Yeah, actually, I'll put Smith Pty.
The other one also, when you go back to the trust, so I'll just throw it out here. You can distribute to an SMSF if you wanted to, but just be wary that would be treated as non-arm's length income. Yeah, there are a couple of rare circumstances you do so, because obviously 45 versus 47, sometimes it's worthwhile. It's not treated as a contribution in the fund, but potentially. So it's never been an issue. But anyway.
So then we put the clause that relates to this. If there's no clause on the DG,
I think that was 6.5, if I remember correctly.
I think it is.
Don't quote me on that.
And then we can move on to the next section. Just checks. I always use this as a bit of a checking mechanism to see if it's picked up all the signers that you believe should be there. As I know, Roger Smith is the sole director of the trustee. I know that to be correct. And we finish the document. This is the engine puts it all together, all the responses.
I want to show you a bit of a hack too, not so much for the guys on POIG, but the definitely for our subscribers, the Unlimited guys, and who obviously always strategists, LY firms, and also licensees. So I
think I know what you're going to do.
I know it's brilliant hack. In fact, it's great for investment strategies. Great for this.
Yes.
Great for deed upgrade. It's amazing.
So we've got the obviously the title page, the sign off on the master template from Abbott and Morley, and the minutes in relation to resolving the distribution, which is extremely important. It's whilst the tax office doesn't state that it needs to be recorded in writing, it'd be very difficult to prove to them that it hasn't been. And I mentioned that in the recent webinar I did on it. So certainly the best mechanism is by holding a meeting and putting the details of that meeting in writing. So we're here resolving to distribute the income on the basis that we put.
I know it's also funny always that that people say, oh, but the commission's never gone in and audited it at all. But geez, it'd be what an easy way, given our budget state of the budget, what an easy way to repair the budget. Imagine there's 800,000 discretionary trusts in Australia, and if the commission went through and found, I mean, you probably know how many people
be able to wind back unbelievable amounts of.
Well, I mean, and you taxed at 47%, the trustees taxed, it'd be huge amounts of revenue, and of course, the clients will be looking at the accountants, no doubt.
Correct, and especially if they could prove that you hadn't actually done it pre-30 June as well.
Actually, just have a look at, see how that's specific. And I love that, because I think that's right up front. So the proposed distribution of income, $10,000 non-assessable exempt income, including cash flow bonus for Roger Smith. You know, it's right there in your face. And again, it's all sequenced and links back to the legislation. So that's a prime one for us there.
That's correct. So that's all got that covered off. It's ratified and then executed by the trustee.
Okay, so I want to just go and we'll play around with this. So just go back to your docs. Can you go into your vault and pick up that document? So what Michael's doing, you can see he's going into his vault. And so all of our documents are in the vault. He's going to go into the document we just picked up, which is the MJ test. You can see down there at the bottom. What he'll do is open that up.
So because of the great naming convention there, we can see it straight away.
Absolutely, it's crucial. In fact, I've seen a couple actually use their client names in their folders. So you'll see there, we'll go to the relaunch. Now what happens is that pulls up I'm going to show you. So that pulls up the stuff. And this is important. You can do the same with the investment strategy, same with the superannuation fund, and the same, obviously, with these minutes. So this is still going to be the same, but you're going to change it now to 21.
21.
Then we'll go down to the distribution of income. So, sorry, the next
Financial year.
Yep, 21. And then beneficiary distributions. Okay, so what we're going to do is for Roger Smith, there is no of that. There's none of that cash flow bonus. So
well, 21 there actually will be because of Q1.
Oh, it is too. So we'll just leave it in again. Well done.
Yep.
So that's all we have to do, and we press that, and we
may have to change the amounts, obviously, because the income of the trust overall may have changed from year to year.
But there you go. That's the quickest way of doing trust distribution minutes. And virtually you could do 200 in probably about 3 hours. Once you get that first lot down, that's the crucial. And that's why it's important to have a good solid foundation, then move from the foundation and then up from there. So I've got here a question from Debbie Potts. If you have a partnership of trusts, so that's what you had before, does the non-assessable exempt income flow to the separate trusts to then on flow to the individual beneficiary? Yes, if you've got a partnership, again, it's going to depend if you saw Michael when he did his allocation. If it is a partnership of trust and that item goes through, then it's going to be split according to whatever that partnership is, and then that'll flow down through to the individuals, and you'll have to do it down to the next level. So you'd obviously be doing trust distributions for the main trust, and then trust distributions for both of the other trusts. Would you agree with that one, Michael?
Do, yeah.
Okay. If there is a trust loss, is it still possible? Yes, it is, because it's actually non-assessable, non-exempt income. So that's a really good question, Lyndall, which means that from that perspective, and if I have a look, let me just share my screen.
It's always important. I was chatting to you just before the webinar, Grant, that exempt income is always, if there's a loss in the trust, the exempt income is always offset against that loss as the first offset.
Absolutely. And I think if I've got it here, there you go. Here's the, that's not the wrong one. Oh, here you go. Here's the fact sheet for employers. So if I just go down here, we'll see, because I did so much digging around and had a look at the tax office, and they were pretty hopeless. But what we've got here is what you're looking at, Lyndall. All cash flow boosts are tax-free. They're non-assessable, non-exempt income, and are not required to be paid back. So that's exactly the same as anyone who receives a lump sum or pension income post age 60 is non-assessable, non-exempt income, which is both Lyndall and also Michael pointed out, is otherwise what would happen there is it would start to eradicate any losses. John Stitt, what do you think about this one, Michael? We always date our resolutions as 30 June. Is that okay?
That's fine, as long as the actual trustee met and made a resolution on the 30th of June. So it should always be the actual date that they held the meeting. So as long as the trustee is aware that they held that meeting on that date to make that resolution, that's fine. So I think it's just important that your clients are aware that of the process and around it all.
Another one, what happens if a unit trust is distributing a family trust? Well, that would be the same thing as if we go from the partnership trust down. So you'd have to obviously have a unit trust distribution. Just be mindful, much the same as if you have tax deferred or tax-free income coming out of a property unit trust, the same way in this instance that it does go to reduce your cost base. So it does go potentially to reduce your cost base. I'd have to have a look at it a bit further, but just be careful of that one, do a bit of research. But otherwise, it's going to end up being exactly the same. So again, a great question. Anyway, we're out of questions here. Let me just go through the final one because we've got a couple of things just to finish off on. We've got a virtual strategy summit coming up on the 14th and 15th of July. It's a 2-day extravaganza. We've got about, how many speakers we've got, Michael? Probably about 20 or so.
Yeah, I'd say 20 off having guessed, but it's going to be an awesome event. It's
yeah. So we've even got cocktails and we've got exercise sessions at the end. So it's just a full strategy feast for 2 days. Now, the important thing about that is for those of you who are Lightyear Docs registered users, and that's quite easy, you just need to jump on Lightyear Docs. You'll get information from us, but you can go on and use your general admission ticket and use the code LYN0CPD, and that'll give you a free ticket. You can't beat that. But if you want to get 11 hours of CPD, what a great way to start the 2021 financial year. And also, obviously, if you see a CPD year, just go LYCPD and it's only $99. Otherwise, it's $249 for that event. And then tomorrow, for those of you who like your docs, our strategists or licensees, I have my weekly VIP strategy roundtable that comes up. If you need a ticket for that tomorrow, I've got a couple of client case studies where I'm going to be building wills. So that's really hardcore, great stuff. So just contact Sophia at ilovesmsf.com. Nishith Shah, will distributing NANI income to a corporate beneficiary still attract Div 7A if there is a UPE? Do you know what that's about, Michael?
Which one?
Oh, sorry. Will distributing non-assessable, non-exempt income to a corporate beneficiary still attract Div 7A? I would have thought so, because it's still going to end up being a loan amount. Yeah, because you've got capital and stuff like that. So good question though, Nish. Well done on that one. And I think we've got a couple more. John Stitt. These are resolutions, not actually meetings. We send the draft resolution to clients before or by 30 June. That's true.
Yeah, but to make a resolution, and there's been, and to record, so effectively to record that resolution, we're suggesting you have a meeting. So there's a record of the minutes recording that resolution. So the resolution can be in 30
Well,
June.
they're actually both. So if you have a look at our document, it actually says that it's minutes of meeting and resolution, which is both one and the same, because what the process there is, you've got to go and check what your deed says. So what I would be doing there, John, is getting the document out. And remember how, Michael, get it out without a relevant date on it. If you want to just send it out in draft and then a review. If it's in final and it's going to go out at that time, then you can stamp it with a date or get them to write their date in at that point in time. So it's both a meeting and also a set of resolutions. What happens if the only unit holder of unit trust is a company? What's the tax treatment in the company or with dividends? So when it goes into the company, obviously it's going to be non-assessable. And again, it'll be accounting income of the company. Obviously, it's not going to be taxable. So that's going to have an impact, because you'll end up with greater profits to distribute to beneficiaries, to shareholders, but your franking credits are going to be not as fully franked, if that makes sense. Is that the right way to explain that, Michael?
Yeah, so effectively the company will have, it'll set as retained earnings for the company, and then, but you just distribute a franked dividend based on the taxable income. So
yeah, so if you're distributing out that non-assessable, non-exempt income, then when that comes out, effectively there won't be any franking in that. So you're just going to have to watch out when you do your dividend, and like, for example, if you had if you had $100 of dividend assessable with the franking credits, and then you add another, let's say, $50 on top of it, and you distribute the whole $150, then your franking credit is not going to be the same amount. It's only going to be 66% franked.
Correct.
Lyndall Carlin. So if a trustee's loss is brought forward, does the NANI cash flow boost reduce this loss? No, not at all. That's correct, isn't it?
Yeah, correct.
Cool. Good set of questions, guys. What we'll do is I'll take this. I'll give you the slides, and then what we'll do from there. Michael's always really brilliant. Yeah, Michael's pretty brilliant at that. So must be the name. What I'll do is I'll send out the slides, and then we'll shoot it off to you early this afternoon. But thanks for a lot of attending. And again, another thing that we'll be releasing, make sure you get onto that 2-day extravaganza, strategy extravaganza. The other one is also on Thursday. We're releasing our non-foreign purchaser discretionary trusts. so that if you're buying a property in any state, you don't want to get stung for that extra 6 or 7% of stamp duty surcharge. So watch out for that, particularly if you want to do a deed of variation. Yeah, it's great, Abbott. Thanks for attending, Mike, today. It was great.
Yeah, thanks, Grant.
Okay, mate. See ya.